Many new investors judge the quality of their decisions almost entirely by what happens right after they click buy or sell. If the result is positive, they assume the reasoning was sound, even when it was driven by luck rather than logic. This habit quietly trains the wrong lessons. A profitable trade made on weak reasoning is often more dangerous than a small loss. Gains earned through poor logic reinforce behavior that will eventually fail when market conditions change. Losses at least create friction that forces reflection and adjustment. In rising markets, beginners frequently mistake a strong market environment for personal skill. When nearly everything goes up, it becomes hard to separate individual decision quality from the overall market tide lifting all assets at once. Structural weaknesses inside a portfolio can remain hidden for years during a bull market. Excess concentration, poor risk controls, and weak diversification often look harmless when prices keep climbing without interruption. The damage only appears when conditions reverse. Many investors focus obsessively on picking winners rather than building a repeatable system. A single successful pick feels rewarding, but it does not scale. Long-term success comes from processes that work across many market cycles. High intelligence and strong analytical ability do not automatically protect against behavioral blind spots. In some cases, they increase confidence without reducing bias. Smart investors are still human, and humans are predictably irrational under uncertainty. Small, unforced errors in process rarely feel urgent in the moment. Over time, they compound silently through poor position sizing, inconsistent rules, and emotional reactions. The cumulative effect can be devastating to long-term returns. Successful investing requires separating decision quality from outcome. A good decision can lead to a bad result, and a bad decision can sometimes win. Judging only by outcomes prevents learning and locks investors into fragile strategies. When feedback loops are short, the brain craves immediate validation. Markets, however, reward patience and punish impatience. This mismatch causes beginners to optimize for short-term feedback instead of long-term compounding behavior. Without a defined process, investors react to noise rather than information. Every price movement feels meaningful, even when it is statistically irrelevant. This constant reaction creates unnecessary trades and emotional exhaustion. A robust investing system is designed to survive mistakes, not eliminate them. No investor avoids errors entirely. The goal is to limit the damage of any single mistake so it cannot derail the entire plan. At its core, investing success comes from disciplined decision-making repeated consistently over time. The market eventually exposes weak logic, regardless of early wins. Building the right habits early matters far more than early performance. Many investors fall into the trap of assuming that a great company automatically makes a great stock investment. Strong products, admired leadership, and growing revenues feel reassuring, but they do not guarantee attractive future returns at the current price. Stock prices are forward-looking by nature. They reflect collective expectations about what will happen next, not what has already happened. A company can be executing perfectly while its stock delivers disappointing returns if expectations were already too high. Public information is absorbed by markets with surprising speed. Earnings reports, headlines, and widely discussed trends are usually priced in within minutes or even seconds. Acting on them later often means paying a premium rather than gaining an edge. A low share price is frequently mistaken for a cheap valuation. This error ignores basic math. The number of shares outstanding matters far more than the price of a single share when assessing what investors are actually paying for a business. Market capitalization is the metric that captures the true size of a company. It reflects the total value the market assigns to all shares combined. Ignoring it leads investors to draw false comparisons between companies that are fundamentally different. Complex analysis can feel sophisticated and comforting. Dense models, detailed spreadsheets, and intricate forecasts create the illusion of control. In reality, complexity does not reliably translate into higher returns and often hides weak assumptions. Many investors react to macroeconomic news as if it offers a trading advantage. By the time data is released, it describes conditions that already occurred. Markets tend to move in anticipation, not in response to backward-looking confirmation. This leads to trading decisions based on narratives rather than probabilities. Stories feel intuitive and emotionally satisfying, but markets are driven by expectations relative to reality. When narratives dominate, risk assessment usually suffers. Price and intrinsic value are not the same concept. Price is what the market offers at a given moment. Intrinsic value is an estimate of long-term cash flows discounted back to the present. Confusing the two creates persistent misjudgments. When price rises, investors often assume value has increased. When price falls, they assume value has been destroyed. In many cases, neither assumption is true. Price movements frequently reflect sentiment shifts rather than fundamental change. Understanding valuation requires accepting uncertainty. Intrinsic value is not a precise number but a range. Treating it as exact leads to false confidence and aggressive positioning that leaves no margin for error. Successful investors learn to question what expectations are embedded in a stock price. The key question is not whether a company is good, but whether it can exceed what the market already assumes. That difference determines future returns. Many investors believe that owning a large number of stocks automatically creates diversification. Holding 50 tickers can look sophisticated, but quantity alone does not reduce risk if those assets behave in similar ways under stress. True diversification is about how assets move relative to each other, not how many names appear in an account. When correlations rise during market downturns, portfolios that seem diversified can suddenly fall together. A common blind spot appears when investors buy multiple funds that share the same top holdings. On the surface, it feels diversified, but in reality, risk becomes quietly concentrated in a small group of dominant companies. This overlap often goes unnoticed because performance looks stable in calm markets. The problem only reveals itself when one sector or factor underperforms, dragging multiple positions down at the same time. Adding assets without conviction leads to what is often called diversification. Low-quality or poorly understood holdings dilute the impact of strong ideas and reduce overall portfolio efficiency. More is not always better. Correlation matters more than ticker count because it determines how risk behaves in different scenarios. Assets that respond differently to economic conditions provide protection when uncertainty increases. Home bias is another subtle concentration risk. Investors tend to overweight their domestic market because it feels familiar and safe. This creates excessive exposure to one economy, one currency, and one political system. Global diversification often feels uncomfortable because something is always lagging. When one region performs well, another usually does not. This discomfort is a feature, not a flaw, of proper diversification. Many portfolios are simply collections of popular stocks rather than intentional allocations. Popularity does not equal balance. Without a framework, holdings drift toward the same growth drivers and valuation risks. A structured asset allocation forces trade-offs. It requires accepting that some assets will underperform in any given year. This discipline prevents chasing recent winners and reduces emotional decision-making. There is also a point of diminishing returns in diversification. Beyond a certain level, adding more assets does little to reduce risk but increases complexity and management errors. Effective diversification is deliberate, measured, and aligned with long-term goals. It is not about avoiding losses entirely, but about controlling how much damage any single outcome can cause to the overall plan. Human psychology reacts far more strongly to losses than to gains. The emotional pain of losing money feels roughly twice as powerful as the pleasure of an equivalent gain. This imbalance shapes behavior in subtle but damaging ways. Loss aversion often leads investors to hold losing positions far longer than logic would justify. The hope of getting back to break-even becomes the primary motivation, even when the original thesis is no longer valid. Anchoring to the original purchase price reinforces this behavior. Investors treat that number as meaningful, even though it has no relevance to current fundamentals or future prospects. The market does not recognize personal reference points. A stock does not know or care what price an investor paid for it. Every trading day starts fresh, based on new information and shifting expectations. Clinging to past prices creates emotional inertia. At the same time, many investors sell winners too early. Locking in a gain provides immediate psychological relief and a sense of competence. Unfortunately, this habit cuts off the very compounding that drives long-term returns. Confirmation bias then reinforces existing positions. Investors actively seek information that supports their holdings and dismiss data that challenges them. Legitimate risks are filtered out to preserve emotional comfort. Recency bias compounds the problem by projecting current trends indefinitely into the future. When markets are rising, optimism feels justified. When markets fall, fear dominates, even though both conditions are temporary. These biases interact in destructive ways. Investors hold losers because of loss aversion, sell winners because of emotional relief, and justify both decisions through selective information processing. Fear of regret plays a powerful role as well. Avoiding future embarrassment or self-blame can outweigh rational analysis. Decisions are made to minimize emotional discomfort rather than maximize expected outcomes. Ironically, attempts to avoid regret often create more regret later. Poorly timed exits, missed compounding, and unnecessary trades leave investors dissatisfied with both their process and results. Awareness of these biases is necessary but not sufficient. Knowing they exist does not prevent them from influencing behavior. Systems and rules are required to counteract emotional impulses. Successful investors design processes that reduce discretion during moments of stress. By limiting the role of emotion in decision-making, they create space for rational judgment to operate consistently over time. Most new investors define risk almost entirely as daily price movement. When markets fluctuate, it feels dangerous, even if the underlying businesses remain healthy. This narrow definition leads to defensive behavior that can be costly over time. Volatility is visible and emotionally uncomfortable, but it is not the primary threat to long-term wealth. The more serious risk is the permanent loss of purchasing power, especially when inflation quietly erodes real value. Holding large amounts of cash often feels safe because the nominal balance does not move. In reality, inflation guarantees a gradual decline in what that cash can buy. Stability in numbers can hide real economic loss. Market volatility is the admission fee required to participate in long-term compounding growth. Without accepting short-term fluctuations, investors exclude themselves from the returns that historically reward patience. Ironically, avoiding volatility can create long-term fragility. Portfolios built to minimize short-term discomfort often lack growth assets, leaving them vulnerable to inflation and longevity risk. Waiting for the perfect time to invest is another common mistake. Investors delay entry until conditions feel safe, but safety is usually recognized only in hindsight, after prices have already risen. Time in the market has proven far more important than timing the market. Missing even a small number of strong days can dramatically reduce long-term returns, especially when compounded over decades. Risk capacity and risk tolerance are frequently confused. Risk capacity is mathematical and based on income stability, time horizon, and savings rate. Risk tolerance is emotional and often unstable under stress. Designing a portfolio based only on emotional comfort leads to underexposure to growth assets. Over time, this increases the likelihood of failing to meet long-term financial goals. A well-constructed strategy balances volatility with growth potential. It acknowledges discomfort as unavoidable while ensuring that risks taken are intentional and aligned with objectives. Understanding risk requires a longer time frame. Short-term losses are noise, while long-term erosion is signal. Investors who reverse this perspective often make better decisions. Accepting uncertainty is a prerequisite for earning returns. Those who demand certainty usually pay for it through lower growth and reduced financial resilience over time. Many investors underestimate how small costs quietly compound over time. Expense ratios feel insignificant in a single year, but over decades they act like a persistent drag that reduces the power of compounding without ever drawing attention. A difference of 1% in annual fees may sound trivial. Over a long horizon, that single percent can erode a substantial portion of final portfolio value, often amounting to decades of lost progress. Fees are especially dangerous because they are guaranteed. Market returns are uncertain, but costs are paid every year regardless of performance. This asymmetry works relentlessly against the investor. Taxes create a similar hidden drain on returns. Short-term capital gains are often taxed at higher rates, reducing the amount of capital left to compound. The impact is rarely felt immediately, but it accumulates over time. High turnover strategies trigger frequent tax events. Even when trades are profitable on paper, the after-tax result can be disappointing. What looks active and productive can be mathematically inefficient. Chasing high dividend yields introduces another risk. A large payout can signal underlying stress if earnings cannot sustain it. Yield without durability often leads to capital loss that outweighs income received. Many investors also rely too heavily on willpower to stay consistent. Manual investing decisions are vulnerable to distraction, emotion, and procrastination. Automation removes friction and reduces the chance of costly delays. Failing to maximize tax-advantaged accounts is a guaranteed loss. These structures exist to reduce taxes legally, yet many investors underuse them while focusing on more complex strategies with lower impact. The cumulative effect of fees, taxes, and friction is rarely visible in a single statement. Together, they form a powerful headwind that quietly limits long-term wealth accumulation. Treating the stock market like a casino amplifies these costs. Frequent bets, emotional reactions, and short-term focus increase turnover and expenses without improving expected returns. Viewing investing as partial ownership of businesses changes behavior. It encourages patience, lowers unnecessary activity, and aligns decisions with long-term value creation rather than short-term excitement. Long-term success often comes from removing inefficiencies rather than adding complexity. Reducing costs, minimizing taxes, and automating discipline create durable advantages that compound silently over time. Wealth is often created in the quiet gap between ego and income. When spending grows slower than earnings, surplus capital becomes available for compounding. When ego drives lifestyle decisions, that gap disappears before investing even begins. Many investors believe success comes from finding extraordinary opportunities. In practice, minimizing unforced errors has a far greater impact. Avoiding obvious mistakes preserves capital and keeps compounding working uninterrupted. Time in the market remains the dominant factor behind geometric growth. Returns build on themselves when capital is allowed to stay invested through multiple cycles. Interruptions break the compounding curve more than most people realize. A written investment plan acts as an anchor during periods of stress. When markets become chaotic, memory and emotion distort judgment. A clear plan reduces reactive decisions by replacing impulse with structure. Consistency often outperforms brilliance. Boring execution, repeated year after year, compounds quietly. Exciting strategies tend to attract attention, but also increase the chance of costly deviation from the plan. Focusing on controllable variables improves outcomes. Savings rate, asset allocation, costs, and behavior matter far more than forecasts. These elements remain within reach, regardless of market conditions. Trying to beat an arbitrary benchmark can distort priorities. It encourages excessive risk and short-term comparison. Financial independence, not relative performance, is the outcome that actually changes life choices. Portfolios are personal systems, not abstract competitions. What works for one investor may fail for another due to differences in income stability, time horizon, and emotional tolerance. Alignment matters more than optimization. The best strategy is the one that can be followed during discomfort. If a portfolio demands perfect discipline, it will likely fail at the worst possible moment. Sustainability determines long-term success. Simpler portfolios are often more resilient. Fewer moving parts, reduce decision fatigue, and execution errors. Clarity makes it easier to stay invested when uncertainty rises. Long-term investing rewards patience, humility, and restraint. It penalizes ego, overconfidence, and constant intervention. Accepting this trade-off shifts focus from excitement to durability. In the end, the best portfolio is not the most impressive on paper. It is the one an investor can hold indefinitely, through optimism and fear alike, while allowing time and discipline to do the heavy lifting.